China's sovereign bond prices fell Monday, pushing yields to their highest levels this year, as investors trimmed holdings on bets that additional fiscal spending will boost growth and push back interest rate cuts. Yields on China's 10-year government bond, which move inversely to prices, gained over 10 basis points on Monday to hit 1.865%, their highest level this year, according to LSEG data. It marks a rise of 25 basis points from January's record lows. Yields on 30-year sovereign bonds climbed above the key psychological level of 2% to reach 2.030% on Monday, while yields on the one-year note also gained 10 basis points to hit 1.643%. By 1 p.m. in Beijing, yields had paired some gains. Growth optimism has returned in China, Frederick Newman, chief Asia economist at HSBC Bank, told CNBC via email. The National People's Congress signaled a stronger pro-growth stance by the government, centered on fiscal easing. Chinese government bond yields have climbed from historic lows in January amid optimism over prospects for the economy after officials set an ambitious growth target of around 5% in a high-level government work report last week. Beijing also announced a rare increase in its fiscal budget deficit to 4% of GDP, the highest since at least 2010, along with a plan to issue 1.3 trillion yuan, $178.9 billion, in ultra-long-term special treasury bonds in 2025, marking an additional 300 billion bond issuance quota from last year. An increased supply of bonds typically makes existing bonds less attractive to investors, pushing down prices and supporting yields. Government bond issuances could be further ramped up if trade tensions with U.S. intensify, said Ju Wang, head of Greater China FX and Rates Strategy at BNP Paribas. There is still room for long-end rates to correct further on a potentially faster issuance pace of long-dated bonds, the government's aim to boost property market and consumption, and ongoing equity rally, Wang said.